Andy comes to us with a great deal of experience in banking, having worked at Brown Rudnick for 12 years, did you say? 15 years?
13 years.
13 years. Having served as counsel to the governor of Rhode Island, also having worked on the state of Rhode Island's financial crisis that it experienced in 1990, 91, at the time of massive failures of the credit union industry in that state, along with the recession that we were experiencing in this area. Of late, he's been devoting a tremendous amount of time in advising clients, both on the business, again on the legal side, with respect to exotic instruments, what used to be exotic instruments, but now we're all learning they may be exotic, but they're a little more known to us. And Andy's going to try to shed a little more light on credit default swaps for us today.
Good afternoon, and thank you very much for coming today. As Con indicated, my assignment today is to drill down in a little bit more detail on credit default swaps. That's a concept that maybe a number of you may not be familiar with at all. Some of you may know more about them than I do. My intent today is not to talk so much about the structure and the pricing and the contract terms of credit default swaps, but rather to focus on it sort of from a regulatory perspective. And by that I mean, what sort of systemic risk do credit default swaps potentially pose to the economy? How are they regulated? Are they regulated? Should they be regulated? And so I want to, again, look at this from sort of a regulatory perspective. But that does lead me to my first and only disclaimer for the day. Are there any regulators in the room? Oh, I guess I'm in trouble now. I am not a regulator. I have some good friends that are regulators, and I certainly empathize with regulators. They operate in a very difficult environment. I do have a little experience having worked in the government sector, understand that the issues of transparency and process and fairness that have to be dealt with even before you get to the substantive issues. So I want to apologize in advance, I guess, for anything that I say that may in any way be disparaging to regulators. Now, before I get into the credit default swap discussion, though, I would like to just recap very quickly where we are today, how we got there, what's happened on over the last year, and with a particular emphasis on how Congress and the regulators responded to the issues. And I want to do this in part to put credit default swaps in context, but also to just indicate how many amazingly diverse and complicated issues the regulators have been faced with over the last year. So where are we today? I always tried to find an image. I think this one says it for me about the best. If you see the sign in the window, it says, "Keep the faith." If you analogized our situation to the plane that landed on the Hudson a couple of weeks ago, I'd say, from my perspective, we've just splashed down. The doors aren't even open. We don't know if there's any tugboats in the area, or whether we're going to be able to stand on the wing, or whether we're going down or going to float and be saved. It's a pretty tough situation. This sign might be contrasted with one you found a year ago in a bank window that says, "We can loan you enough money to get you completely out of debt." So there was a lot of blindness going on, and I, in my mind, I sort of have broken down what happened in the last year and a half into sort of 5 stages. Just to overview the last couple of years. What sorts of things went wrong? Well, obviously most people will point to the housing bubble as being sort of the root issue of where we are today. Easy credit, subprime lending, artificially inflated home values, all those things led to, well, when that bubble burst, it became apparent that there were a number of flaws that were exposed in this whole secondary market housing finance process. Rating issues, problems at Fannie Mae, Freddie Mac, all of those kinds of issues came into focus. And also as a result, it became apparent that there was a valuation issue with a lot of mortgage-backed securities, asset-backed securities, other types of exotic securities, and you've heard the term toxic assets. That in turn led to a real liquidity crisis. People didn't know, how to move these securities, and even banks began to close down lending among themselves, interbank lending, Fed funds shut down, and we were faced with a liquidity crisis. Of course, this whole thing has been now exacerbated by the recession, regulatory failures to some extent magnify the problem. So, having said that, what were the responses? First of all, legislative responses. I point out that there are actually two major pieces of financial legislation that passed last year. The first one was the Housing and Economic Recovery Act of 2008, which created the framework for fixing the Fannie Mae and Freddie Mac problem. It created a new regulator, the Federal Housing Finance Agency, and gave them the authority which was ultimately used to take over Fannie and Freddie. And then, of course, ESA, the Emergency Economic Stabilization Act, was passed. You all know the story there, $700 billion of assistance, authority to increase FDIC insurance, negotiator taxpayer benefits. And you probably all very familiar with those provisions. But what I wanted to focus on mostly was the regulatory responses. A tremendous flood of regulatory actions occurred last year. And again, I just want to click through very quickly a dozen of these, not so much to focus on each one, but to just give you a flavor for the complexity of the issues that regulators had to face and how they responded to them. Each one of these would be a major event under any circumstances. To have so many occur in such a short period of time was just staggering. Of course, it started with Bear Stearns. First one I'm using as an example, with the bailout of Bear Stearns, Federal Reserve lending almost $30 billion in that effort. The next one is, I mentioned already, the Federal Housing Finance Agency bailing out Fannie Mae and Freddie Mac. The third one is actually a non-action, the non-bailout of Lehman Brothers, but I put it in here because it was a regulatory decision. Regulators decided not to act rather than to act in this context. I'm going to focus, the reason this is bolded is I'm going to focus on AIG and the $85 billion lending by the Federal Reserve to AIG, in part because it was very intricately tied to the credit default swap problem. But let me just, again, click through some more very quickly to show you the number of regulators that were involved in responding in some way. I mentioned the FHFA, the Fed, the Treasury, the SEC gets into the act, suspends short selling of financial stocks. Treasury guarantees money market funds, remember that? That was a big deal. Federal Reserve approves the conversion of 2 investment banks to financial holding companies. Again, this is a major event. Morgan Stanley and Goldman Sachs are no longer freestanding investment banking companies. They're financial holding companies regulated by the Fed. That's a major change in the environment, in the banking environment. The Office of Thrift Supervision and the FDIC got into the act. More regulators, there's a lot of regulators out there, putting Washington Mutual into receivership, selling its banking assets to JP Morgan, Chase. Here's a favorite of mine. The Federal Reserve on September 29th pumped $600 billion of liquidity into the system. This is even before the $700 billion that's made available through legislation, and it's done through open market activity and other mechanisms by the Fed. And I had to come up with another image because this one always reminds me of, like blowing up a balloon and it's not clear what's going to pop next. Next, Federal announces they have the creation of a commercial paper funding facility. The Treasury gets into the act through new rules under TARP, not just to buy the toxic asset, as Eric mentioned, but also to invest directly in banks, direct capital infusion in banks. The FDIC uses emergency power, special power, to guarantee banks commercial paper and Fed funds through this temporary liquidity guarantee program. And in November and December, 2 more major financial institutions join the ranks of financial holding companies under the Bank Holding Company Act, become subject to the supervision and regulation of the Federal Reserve. So, as I indicated, this is a tremendous number of things occurred in a very, very short period of time, and you know, in this image is who's in charge here, and I guess I would submit that to some extent the regulators are really making a lot of decisions here that have very, very far-reaching policy implications. So let's talk about credit default swaps a little bit. For me, this is an example of something that went horribly wrong, where the regulators really didn't have the tools available to deal with it. And to some extent didn't even see it coming because it happened in sort of such a stealth manner off of the normal exchanges where securities get traded. What is a credit default swap? Very quickly, very simply, it sounds like an exotic instrument. It's really just a very simple contract between 2 parties called counterparties. One party is the seller, and they are selling protection against a default of something called a referenced financial instrument. The buyer is a party who may want to hedge their portfolio, a hedge fund, for example. It may want to protect themselves against a certain kind of risk. And there's always, of course, a referenced financial instrument. And that referenced financial instrument may be any third-party obligation. Now, this is an important point here because the thing that, well, I guess I'm just putting up an example here quickly. AIG, as the seller, enters into a contract with a hedge fund to pay a specific, the hedge funds, I'm sorry, the seller will pay a specific dollar amount if the collateralized debt obligation to CDO that has been issued or referenced defaults. But the important thing to remember and to understand about credit default swaps is that neither the buyer nor the seller needs to own any interest in the referenced underlying security. And this is a really critical point to understand because there often is no other collateral in these transactions, at least if the issuer is a highly, a highly rated entity or an organization that doesn't need to post additional collateral. But to my mind, swap is really a misnomer in this sense that the seller isn't swapping anything. The seller is essentially just identifying a security out there in the marketplace and agreeing to hold a buyer protection harmless if that security defaults. And the reason that the result of this is that a seller can engage in multiple transactions with respect to the same referenced financial instrument. And there are a number of institutions, including AIG, sold protection on the same referenced instrument to multiple buyers. So that if there was the referenced instrument was a $10 million security and AIG guaranteed the default, that's a $10 million liability. But if they sell the protection on the default of that to 10 different buyers, there's a multiplier effect, and it immediately balloons into a much larger type of liability or obligation on the part of the seller. And as a result of that, you've heard these staggering numbers that, the market, and I don't guarantee any of these numbers, I'm taking them from a variety of different sources, but conventional wisdom was that there was something in the order of, $60 trillion worth of these credit default swaps floating around in the marketplace. And that number, just to put it into context, is almost twice the size of, or twice the value of all other securities that are traded on all other, formal exchanges in the country, and dwarfs the United States gross domestic product, a multiplier of about 4. So there's a lot of this stuff out there, and the issue is, how are they regulated? Are they regulated at all? And to just give you a little bit of the context and history behind this, the question kind of came up in as early as 1974. Not that credit default swaps even existed. The credit default swaps are a brand new type of instrument. I think my last slide there indicated that these have only been in existence since about 1997, when J.P. Morgan issued a credit default swap, and which makes the size of the market even that much more staggering in my mind. This is only a little over 10 years that these have grown from nothing to $60 trillion. But I put this act up on from 1974, the Commodity Futures Trading Commission Act, because it created the CFTC, and one of the issues that has been debated, that was debated for 25 years following this, was whether these kinds of sort of derivative financial instruments were either commodities, whether they were futures, because they dealt with a future event, a future type of financial interest. Were these different types of derivative instruments that were being created subject to CFTC regulation? And that was, it was uncertain and unclear for many, many years. 1999, a couple of things happened. I put up Gramm-Leach-Bliley mostly just because that's sort of the watershed year in terms of the beginning of, not the beginning, but the merger of these industries, banking, securities, insurance, and sort of a blurring of what regulator ought to be responsible for what kinds of activities and what kinds of institutions. But also in 1999, the President's Working Group was asked to look at the issue of the derivatives market and to come up with some recommendations, which made their way into a piece of legislation in 2000, the Commodity Futures Modernization Act. Now, the significance of the Modernization Act is that it clarified, it statutorily decided this issue of whether or not swaps should be subject to CFTC regulation, and it answered in the negative. It said if transactions are entered into over-the-counter, that is private party-type transactions among qualified institutional parties, and that these swaps would be excluded from being regulated by the CFTC. It went on to even say to prevent the SEC from regulating. So these instruments essentially fell through the cracks. And you will see when I sort of flip through what went wrong, they were not a commodity or a future subject to CFTC. They're not an insurance, they're not subject to any insurance regulation, even though they look and feel and walk and quack a little bit like an insurance policy, but there's no insurable interest. There's no, so they're not insurance, they're not subject to insurance, And because a lot of the players that played in this market were not banks or were not regulated, the institutions themselves often did not have a primary federal regulator sort of looking at the balance sheet of the institution that was involved in these types of transactions. And investment banking companies, were very lightly regulated and weren't regulated in a traditional banking sense. AIG, while the insurance operation was regulated, this problem arose at AIG at the holding company level. The holding company was not regulated by any primary federal regulator. Another issue, another thing that creates a problem with credit default swaps is there's really, as I mentioned, no underlying asset. So there's no potential for recovering against, some asset that underlies the transaction. It's a loss proposition if there's a default. Another thing that obviously led to this problem was that these were not handled on exchanges. They were over-the-counter private types of transactions, and there was this astronomical growth in the industry. So just quickly, AIG, this is just an example of what went wrong. Estimated $500 billion issued by AIG of credit default swaps when securities of various types turned toxic, and the ratings were reduced. Collateral calls were put to AIG and other issuers of credit default swaps that they couldn't meet. In September, the Fed steps in, as you know. Third quarter loss for AIG, $25 billion. Over $7 billion of that was a valuation loss related to their portfolio of so-called super senior credit default swaps. So there's obviously huge losses in these portfolios, and by some estimates, there's still AIG still has faced, with over $10 billion worth of exposure. So what did the regulators do? Well, they didn't have much that they could do, so they exercised this emergency power to come in and lend to a non-banking institution. This Section 13(3) of the Federal Reserve Act allowed them to act in unusual and exigent circumstances, providing a loan to a non-bank institution. Interestingly, this section has only been used 3 times since 1934, all 3 last year: Bear Stearns, the AIG loan, and most recently the establishment by the Fed of their commercial paper lending facility. What's next? Until there is legislation, there isn't there aren't a lot of things that can be done. The regulators have entered into a memorandum of understanding, all the regulators, the CFTC, the SEC, the banking regulators, to consult and share information. I mean, when everything else fails, consult and share information. But the primary move right now appears to be to try and push credit default swaps onto public exchanges. And at the end of last year, the Chicago Mercantile Exchange established a clearinghouse that was accepted, and so CFTC now has certified this marketplace. If nothing else, it will make them more transparent, and there will be a better ability to get a handle on just what's out there and who the players are. I recognize that regulators have a lot of issues that they have to face. And this is an example of lack of power to regulate. Also an example of what is an emergency, when do they act. This has an interesting policy implication. What tools should the regulators implement? In the context of AIG, they not only invested in AIG, the government invested, it lent, it provided guarantees. All 3 tools have been used to prop up AIG. And for me, this is to sort of wrap up, it creates a number of significant policy implications. And the biggest one that I think is associated with the AIG and the swap is this issue of too big to fail. And I mentioned a couple of different situations here: J.P. Morgan, Bear Stearns, WAMU, Bank of America, Merrill Lynch. These are all transactions that have been approved by regulators. There wasn't any federal legislation that was passed to combine these. So I guess my sense is that the regulators are creating a problem here as much as solving one by creating these behemoths, particularly ones like AIG that don't have a primary federal regulator on board. I'll skip these points, and rather than leaving you with a real downer image at the end, I will come back to where I began, which is keep the faith.
Good.